Hello, everyone, and welcome to today's webinar entitled The Brutality of Commercial Lending and the Promise of Automation, presented in partnership by Wolters, Kluwer, and Aite Group. Wolters Kluwer Lien Solutions provides award-winning tools for lenders, including its flagship Lien offering, which gives lenders the ability to conduct public record searches, retrieve and view uniform commercial code and corporate records, create filings, and manage their entire lending portfolio. Aite Group delivers research and guidance to leading institutions and technology providers across the global financial services industry. With expertise in banking, payments, insurance, wealth management, and the capital markets, they guide financial institutions, technology providers, and consulting firms worldwide. I'm your host, Rob Zurich from Lien Solutions. In this webinar, our presenters will guide the audience through the brutal business of commercial lending and describe the confluence of new technology, new competition, and uncertain regulation that has redefined what it means to be a lender. But there is hope. Our presenters will also show how new technology with advanced digitalization and automation can reinvent the commercial lending landscape and remove obstacles for growth. With that, let's get started. I'm thrilled to be joined today by Suzanne Konstance and David O'Connell. Suzanne serves as Vice President of Marketing and Product Management for Wolters Kluwer's Lien Solutions. She leads a team focused on understanding and solving market problems in order to provide effective, innovative solutions and execute powerful go-to-market strategies. Prior to joining Lien Solutions, Suzanne held senior-level product management and marketing positions for Pitney Bowes, Citibank, and MetLife. She earned her BA from Cornell University and an MBA from Kellogg School of Management at Northwestern University. David O'Connell is a senior analyst with Aite Group, where his primary coverage area is lending. A former commercial lender of 14 years, Mr. O'Connell brings extensive hands-on and granular knowledge of banks' challenges in building businesses that lend safely, cost-effectively, and at scale. Mr. O'Connell holds a BS in Business Administration from Providence University and an MBA from Boston University. Please note that all audio lines will be muted for the duration of the presentation, but questions can be asked at any time using the Q&A prompt box found at the lower left portion of your screen. We will answer questions as time allows following the presentation. Additionally, a recording of this webinar will be available in the coming days at liensolutions.com. We will share a link via email as well and encourage you to share that webinar link with your colleagues. With that, it's my pleasure to pass it over to David O'Connell.
Great. Thanks so much, Rob. Indeed, I think we have a lot of interesting things to think about. I'm just going to walk us through a bit of an agenda here. First thing I want to talk about is the really challenging environment that I see lending institutions facing in terms of rates, profitability, and the general climate out there. It feels like we really might be at the top of an economic cycle and the top of a credit cycle, and I want to talk a little bit about that. To me, these three things, rates, then profitability, and the toppy feeling of the market, means that there's very little room for error in the lending environment. I'm reminded of that quote that we all encountered if we credit trained, and that is that for every loan that goes bad, you have to book almost 1,000 loans to make up for that. With things being very toppy, we need to keep those banking basics in mind. Okay. Now things aren't all only challenges. Okay. We think that here in this environment is not only the need for an antidote, but also kind of an opportunity. Because one area in which we see a need for more discipline is liens. And liens, in fixing those processes, we see an opportunity to provide the borrowers with a more digitalized experience, and frankly, kind of upgrade the role of the loan officer in, I think, a far better future state for them. Okay, so the first thing that's on my mind with regard to the environment that's faced by commercial bankers in general and commercial lenders in particular. First of all, soaring demand for debt and use of debt by businesses. This chart is a bit crammed. I'm sorry about that horizontal axis. I'll unpack this slide for you pretty simply, though. Basically, that dramatically upward sloping line tells you about the volume of business loans booked since the end of the global financial crisis. It's gone from almost 1.2. It's gone from 1.2 trillion to almost doubled to a little over 2.2 trillion sometime last year. That's a great deal of demand. And of course, we're all kind of economists. Whenever we see demand increase, we usually see favorable pricing environment. But we're actually not seeing a favorable pricing environment here. This chart presents you three rates. Okay, the lightest two lines are our costs, prime and 3-month LIBOR. That third line, the more purplish one, is called the ICE of Bank of America High Yield. And that is a rate that's used to proxy the spread earned on corporate loans. And look how low that has gone. It's very close to the cost of funds, and it has not at all gone upward as demand has, okay? It's instead been flat and gone downward, okay? That's really not a great situation to be in, okay? And it's not just me, sort of a nerdy analyst, taking an econometric view of things. These razor-thin margins are actually having a pretty kind of a seismic impact on the commercial banking world, okay? And I will summarize that with a bit of an anecdote, okay? A year or so ago, I was having lunch with a former banker colleague of mine, and we were talking about market conditions. My friend Amy, over lunch, she very passingly referred to commercial lending as a loss leader. And as soon as she said it, it really kind of caught my ear as an analyst, and I kind of pressed the pause button during our discussion. I said, hang on for a minute, Amy. What do you mean commercial lending is a loss leader? All that spreading, all that loan origination, underwriting, projections, going to loan committee, putting all that capital at risk, and you're referring to it as a loss leader? And she said, yeah. Basically, there are so many banks out there chasing any given deal that you have to lower your spread over your cost of funds to the point that it's razor thin. But we're okay with it because we cross-sell things like treasury management and hedges and things like that. Well, it turns out that pricing is so razor thin, and it's so incredibly important to cross-sell things like treasury management that the conditions have really kind of transformed banks, okay? And I don't want to make this a discussion about treasury management, but I do want to point out to you how kind of seismic the impact of razor-thin margins have had on the banking industry, okay? Now this collaboration where lenders cross-sell with folks selling hedges or treasury management and doing things like gathering deposits, they're so important, okay, that when we did a study of this, me and a colleague at Aite Group, we found that all 41 of the banks that we spoke to undertook changes of these types on this slide. They were changing HR policies, okay, to ensure that folks were evaluated based on their ability to collaborate. They were changing and emphasizing collaboration in terms of their culture. For example, whenever there was a quarterly or annual meeting among all the different types of banker at a big event, and awards were given out with blue sites and things like that, leaders at the bank would always be up at podiums, banging their shoe on the podium, preaching the message of collaboration between lenders and anyone cross-selling anything, again, because of these razor-thin margins. And also there were changes to things like compensation, okay? Bankers are great game players. When they get their new compensation plan in December or January, it's almost like everybody getting brackets when March Madness comes around. They read them and they respond to them, and their response now is in response to razor-thin margins, they're cross-selling like crazy, okay? Now, it's not just in terms of cross-selling that folks are reacting, okay, but there's also an opportunity to respond to market conditions in terms of having your house in order in case things turn out to be not so great, okay? And I actually think that there's a lot of reason to think that indeed things might not be so great in the not too near future. And in that situation, bad slide build there, sorry folks, but in that situation, okay, you might be really concerned about those razor-thin margins, and you might seek to have your house a little bit more in order in a lot of different ways. And here's what's on my mind there. First of all, there's just the plain old age of this current credit cycle. It's 40 quarters old. Whenever I look at this bullet point, I think that must be a typo. But indeed, it's been 40 quarters since we emerged from the global financial catastrophe of 2008. This credit cycle is longer than the boom that happened between around 1991 and 2000 when we had the internet boom and bubble burst. And it's also longer than the real estate expansion that happened between 2002 and 2008. Okay, and then oh, by the way, what do econometrics folks think is see as driving this? Well, it's being driven by successive rounds of quantitative easing by central banks, which, by the way, have almost no ammo left. In most Western economies, two things are going on. First of all, rates are near zero, which means that if you lower interest rates, it's not going to have too much of an impact on folks' behavior. Oh, and by the way, if you raise interest rates, that's kind of a problem too, because the vast majority of Western economies with central banks, they're running federal budget deficits. And if central banks raise interest rates, they're raising the daily carrying cost of the federal deficit. And by the way, here I am talking about, gee, are we maybe looking at a market top here? I want to kind of scroll back to something I mentioned a few minutes ago, and that was my friend Amy's referring in passing to commercial lending as a loss-leading business. Now, I would put to you that that's actually the two things not great are going on there. First of all, it's not great to be deploying so much risk, okay, and getting barely compensated for your risk, okay? It's also not great that we're getting paid for that risk by another product, primarily treasury management. It reminds me of another maxim that we all are taught early in our banking careers called tenor matching or tenor mismatch. In other words, you always want to have a borrower finance short-term needs with short-term debt, and you want them financing long-term needs with long-term debt. And anytime you get mixing across those, bad things tend to happen. Well, I actually think that something bad like that might be happening in the fact that we're getting compensated for our credit risk as a result of our ability to cross-sell treasury management. In fact, what if profitability on treasury management goes down? Profitability for products like that in the consumer world has gone steadily downward over the past few years. And the last thing on my mind with regard to razor-thin profit margins is another factor that we sometimes think of with regard to bubbles, okay? Everybody's got a different recipe for what they think characterizes a market bubble top. And I recently read a book about the Enron fiasco that happened in 2001. And I have a whole bunch of yellow stickies sticking out of that book that I think characterize a market top. And one of them is the acceptance of the abnormal as normal. And I would put to you folks that it's quite possible that accepting razor-thin margins on commercial lending might be accepting the abnormal as normal. And banks might share this opinion with me, okay? This chart right here is a depiction of the most recent take on credit cultures of banks booking loans to businesses, okay? Wherever you see a bar extending upward from the zero line, folks are becoming more credit restrictive. Wherever the bar extends downward, they're becoming less credit restrictive. And that orangish bar over to the left, credit standards, is a summation of what's going on there, okay? So generally we've got more folks, okay, in more ways, tightening their credit standards than loosening them, okay? Now, interesting to me is that on the right-hand side of the chart, those lines extending upward, again, more restrictive things, they form a bit of a bell curve. And at the center of that curve is collateral requirements. What's going on there is banks are getting more collateral. They're doing it in two ways. First of all, they're going from not asking for collateral if they're lending you money for a tractor or a combine to getting a lien on that tractor or that combine. Or maybe they're asking for more collateral. Perhaps it is an asset-based lending arrangement, and they're going to begin extending credit to 60% of accounts receivable instead of 80% of accounts receivable. Okay, so things definitely getting kind of more restrictive, and that as we were preparing content for this webinar, it occurred to me, what is the job of us lenders? I know I'm not a lender, but I'm paid to to think like a lender because I write about the business. And our job is always to think about where the puck is going rather than be chasing it, okay? Now, a moment ago, okay, I mentioned increasingly restrictive credit collateral requirements, and folks are more likely to be getting collateral. Anytime you get collateral, you need to file a lien, okay? Now, I think liens is actually one area in which folks should be getting a little bit more careful and getting careful ahead of time rather than a reactive way. And one more thing before I kind of hand it off to Suzanne, again, it's our job, okay, as bankers to be where the puck is going rather than chasing it. And what I mean specifically there is if changes happen in the economy, reacting to it with some kind of technological change, you have to get approval for the investment, you have to do the deployment. We're talking several months, several quarters. So I think that actually now is the time to begin being really super careful about those things. And with that, I want to hand it off to Suzanne.
Thank you, David. So why is it difficult if we need to be more disciplined? Why in our environment is it so difficult? There's a few different things that are very special and challenging in lending in the United States. One is that the borrowers tend to use multiple lenders for lines of credit, for loans. They may have some that they're more loyal to, but there is less loyalty in the United States for a variety of reasons, some of them structural, than other countries. For example, Germany, it tends to be that the lender will consistently be working with the same borrowers, and those borrowers are only working with those lenders. Here, you have to really keep in mind the fact that while you're lending to a borrower, they are taking out other loans. They may have liens on the same collateral across a number of loans, and you have to understand your position and you have to understand the overall picture, and that's more of a challenge here. Another challenge we have is just at this point in our economy, there isn't the same level of investment in systems and processes and information across the lending cycle. As consumers, we know that things have gotten much better as far as the digital experience for a consumer, especially at the point where someone's entering a transaction or engaging as a customer with a vendor. Online carts and so forth are so easy. They just lure you into making a purchase. And the same thing on the commercial lending side and lending side, things are becoming simpler to upload documents and to engage as a customer. But all of those processes and systems that are a few steps away in the back end of the lending process are trying to catch up but are not yet there with the same level of transparency and investment at this point. So we find that there are multiple systems and processes and individuals working on a loan, and the typical lender, because we do workflow analysis for our customers and for prospects, we find there's more than 10 different systems they're using to make sure that they go from the beginning of the end of the loan cycle and do everything they need to do. And that means multiple handoffs, many different areas where folks are doing manual entry, where information is sort of trapped or captured in different parts of the process. So this is a challenge when you're managing an overall lending operation because there isn't that kind of streamlined, automated background. In our client advisory board, which includes some of the largest lenders, we know that about 3 years ago, the whole automation of these processes it was really just starting on some of these back-end processes. Now they're much more engaged and there's much more happening, but again, we are not there yet. There is also a greater decentralization, so especially in my area of liens, and I'm going to talk about liens because that's where we focus, but many of the themes are throughout the lending process. Throughout this process of lien management, we find that for a lender, these liens can be created anywhere. It could be one business unit, a lender. Often banks will merge with other banks. There could be portfolios of liens out there in other banks' names. There can also be law firms that did this, especially for the more complicated or larger loans. They will often file the liens. Being able to have everything in one place or manage it is a challenge for any lender. And then it's very interesting how the U.S. is structured, but depending on what kind of lending you're doing, say it's real property or it's commercial transactions or it's Department of Motor or it's vehicle transactions, there are different jurisdictions that all come into play. So you may be working with secretaries of state who have authority, counties, departments of motor vehicle. That means there's over 3,600 different entities that have different nuances, requirements, processes that a lender may have to navigate in order to protect their interests when they're lending. So let's look at a case in point. This is a very simple look at a commercial lending workflow. Again, we do very detailed analysis that gets into a lot more depth. But what I try to do is pull this up and say, what are sort of the truths for most commercial lenders? Well, there's always a loan application process that they need to work through. There's due diligence. There's loan documentation, closing, booking, and servicing. And under each of those general categories of events, there's different activities that they have to undergo. Now, I'm going to focus in on the lien management area, which is our area of specialty, and also it's an area of risk and a lot of complexity, and talk about some of the themes that we see there. So liens, they are critical to manage correctly, and they're very, very tricky. So let's talk a little bit about this. First of all, the system is got some loopholes in it. So a lender may file their liens, do all the work up front, feel that everything has been done well, and when you have that lien set on a loan, it's perfected. It means that you've done all you need to do to hold your position on it. However, someone could go in and release a lien. Things could be changed. Other liens could be created. Positions could change. And there isn't any one way today in the outside environment to know that for most lenders. So that's a challenge to understand if something has happened with that lien. Often folks think if I've said it correctly, I've kind of mitigated my risk, I've done what I need to do. But one manager of document services at a large bank said to me once, you know, that early part is really the easy part. It's later, especially when I'm working on larger loans over time, that I'm worried and that I don't really understand my portfolio. The beginning is the easy part. It's afterwards that it's tricky. So, you know, when you think about it, if you don't have transparency and visibility into all the liens you have and what's happening with them, how do you really manage something this careful? And one thing that we found is that sometimes lenders will put some processes in place for the right reasons, but they may actually add risk. They may be illogical. So one example that we find in the when folks are lending around vehicles is that's complicated because you have to put a lien on the vehicle title. And your customer needs that vehicle title in order to use the vehicle. Now, if this is in the commercial world, your customer may need to get some commercial vans out there just to make money. So they don't want to be delayed in getting that title out there with the Department of Motor Vehicle so they can get those vehicles on the road. We find some lenders tell their borrowers, here, please put the lien on your title when you go to the Department of Motor Vehicles. For the right reasons, they don't want to delay the customer in being able to use the vehicle. But when you really think about it, the borrower is being asked to put a lien on the vehicle on behalf of the lender. That is an odd situation. And what happens is we find that many of those lenders that have that process have large portfolios of titles that have never had the lien put on them. And they are working consistently and spending a lot of money and time and effort. And probably there's an annoyance there too for the borrower trying to get this fixed. So that's a challenge, and it does put a lender at risk. Some interesting stats here: 60% of debtors have a change event every year that could impact a lien being able to stand up for the creditor. There are over 5 million different scenarios in titling and providing a lien on a vehicle. So really understanding that it can't be something that's in somebody's head. You really need tools around that. We find, based on our own analysis, that in-house filers of UCC liens have something like a 22% rejection rate. And this is probably one of the more scary statistics. In looking at liens that have been filed, that are publicly available, we find that when you look at the nuances of them, based on where they're filed, based on the names versus corporate charter documents, about 30% of those could be contested. They may not be perfected. So here's a couple of weird examples, but these are kind of common in this world. One is what happened with a filing that was considered seriously misleading. So basically, the creditor, who is the Wisconsin Department of Finance, filed a lien. The borrower was ISC Inc. And when they filed that lien, they put a space between the last C in Inc. and the period. And interestingly, we even have a little typo in this because we put in additional space. See how easy that is to happen, right? But they had one extra space between the period and the C in Inc. And they actually ended up going to court, and it was judged that that lien could not hold. It was seriously misleading because the Wisconsin search logic rejected that for the extra space, so it would not hold. And that's a pretty minor error. That is something that is very feasible to happen when you're doing manual entry, right? So these are some of the challenges around a UCC filing. And then if I look at a motor vehicle example, recently we had someone come to us. It was a lender in New York City. They had lent money to a delivery van to a firm who was using a fleet of delivery vans. So they financed 1,500 delivery vans in New York City, and they had done everything right, they thought, to put the liens within the titles, but they weren't familiar with some of the DMV requirements. It was a really esoteric one about the timing of escrow and so forth. They thought they had done everything right. They thought they had the liens there, and then they found out later, no, they didn't. They were going to miss a deadline in order to secure the assets, and we had to help them within a week to resolve that. So just some weird different rules and things that people have to be aware of around this kind of process. And what it means is that you can't really take anything for granted. You want to make sure that you have the right tools in order to control the situation as best as possible. And there are situations where you could have someone who is a credit abuser or is fraudulent, and having these kind of loopholes puts you even more at risk. So you don't want to rely on manual processes, and you want to make sure that you can see and see with transparency your portfolio. So let's talk a little bit about tools for discipline, how to gain some efficiency. And again, I'm talking about liens, but this also can be, you can really think about this across all of your processes. So first of all, our experience is that we have to work very closely with our clients to understand problems, whatever problems they have in their process. And then together we can innovate to create solutions. Once we have the solution to the problem, the other two steps are to automate the solution so that you take away things like data entry and very minor errors. And then we also make sure we can integrate the solution, meaning we have to understand the customer's workflow, their systems and processes, and allow any solutions we create to fit right into those versus being a separate point of entry. So that's just sort of the philosophy around this. Now, some examples of what we provide is real-time reporting, so customers can see what's going on with their liens, what's going on with their debtors. They can see things like whether a debtor hasn't paid their taxes, for example, whether they've changed their name or address, any of those kind of things, or created some more liens with other lenders. And then we also brought together all liens for customers. It doesn't matter where they were generated. We can bring them all together into one dashboard so the lender can see them, they can manage them, make changes all from one place. And on that information, we also have analytics. So a lender can look at their operations and understand if there's individuals making certain errors or there's some inefficiencies. They can see if there's situations with different jurisdictions where they have some problems or delays. All of that is in one place for them. And then we automate things that are critical task solutions, like understanding when liens expire, because you do have to renew them in some cases. So understanding that, being able to renew them or even set a renewal to occur based on logic are all things that we provide. And in that way, the customers have an end-to-end system that they can use and plug into their loan system and limit data entry. That's really critical. You want to limit data entry wherever you can to have better quality and less errors. And in looking at the steps that different customers take around the loan process and going through the workflow, and then looking at the solutions that we've built in hand with our customers, we found that about 70% of the processes, just in that one box, that lien management box in the workflow, 70% of those steps could be removed. So pretty good efficiencies with better quality. So the benefits of that is really you're digitizing your experience for the borrower too. There should be greater transparency of information all the way through the loan process, not just in that, the back end process, but you should be able to raise the information so folks can see it and feed into it. You have more accurate lending arrangements. You've perfected and protected your organization's rights, and as a result, lower losses. But another area that always comes up and is very much at the end point of lending is the audit. One thing we want to do is make sure that your process and how you manage your lending, especially where we're playing, the exhaust that comes off of that, the reporting, the data, the information feeds perfectly into an audit, so that your audit experience isn't having to gather more information and create a whole project around your audit. That information, those processes, the documentation of controls should all really be a part of the solutions that you're using. So we think about the audit up front versus as an after effect, because that really does take a lot of time. Now these are two big themes. We use them. I'll give you some examples, but any vendor that a lender is using, there should be a conversation about these capabilities, because these are so important. They're important now, and they're only going to become more and more important. So the first is APIs. And for those of us who are less technical, that stands for Application Programming Interface. Many of our customers that we work with are not chief technology officers. Usually these acronyms are a bit intimidating. But all that means, an API is basically just a way that a system can standardize the way it communicates with another system. So if you have two vendors and they're both managing a piece of your lending process, you want those vendors to have APIs so that they can talk to each other and information can flow, and you can integrate and plug and play best-in-class capabilities together into one flow. So it's really important to look at APIs and make sure that that is a capability that your vendor has. APIs are being used all over. Like anytime you go onto Amazon or eBay, multiple APIs behind the scenes are giving you capabilities and ways to buy things very simply and easily. And by having APIs in your own lending flow, you also have that same seamless automation and integration. The other theme is artificial intelligence, and that's a big focus for our entire company. Really the way, and it's a broad theme, but in particular, being able to take data and make decisions and actions based on that data, so you're not repetitively doing the same kind of steps over and over again, is how often we'll use artificial intelligence to help our customers. So a couple of examples of that. Some of the reason why we know there's unperfected liens in the industry is we have the data, and we've been able to create the right logic so that we can see where there are issues, and we can do that for our customers, and we can do that in the public space. We also use that to look at the liens of customers so that they can see where they are in priority and what else is going on, and there's logic behind that to give them results. Though using artificial intelligence allows you to take your team and kind of rededicate them to add value in different ways and work on new challenges versus doing the more repetitive work based on the same information. Now, with that, I will turn over to David because I know he wants to talk to us a bit about millennials.
Thanks, Suzanne. The reason I'm bringing up millennials is Suzanne mentioned something kind of interesting a few minutes ago. She said that 70% of lien processes could be potentially removed. And as a person who analyzes deployments somewhat continuously as part of their job, I can tell you that I would bet a lot, okay, that a lot of those processes fall upon the borrower, and not only that, but they're badly timed, okay? These processes are inconvenient to the borrower, not when they're engaged at the front of the loan life cycle, but at some other point in the process. In other words, it's bad for the borrower experience, okay? Which brings us to the theme of digitalization, okay? Now, I've spoken in the past couple of months, I happen to be in a fortunate position of asking about 50 or 60 banks about their digitalization efforts, okay, for commercial lending. And the majority of folks said something like this to me. They said, we are currently focused on the front end of the technology curve. We're just trying to get automation in place for commercial lending, and we're trying to get first-order benefits like more scale and productivity improvements. They also tell me somewhat, they're almost kind of embarrassed or reticent. They say, we know that our vendor makes available to us a lot of digitalization capabilities. We're just not there yet. It's on their 2020 roadmap, or maybe it's on their 2021 roadmap. Well, okay, I get it, all right? It's good. It's really good if it's on your 2020 roadmap. It's less terrific if it's on your 2021 roadmap. The problem is that you might not be able to set the schedule, okay? On my mind here is the fact that, millennials, okay, who have been living in a digitalized experience pretty much since they were born, they're increasingly populating your borrowing businesses in important ways. They are increasingly the founders and co-founders of the companies that you're lending money to, and they're increasingly populating the controllers departments where you're lending money. And these are folks who want self-serve borrower portals. They want immediate access to information and continuous real-time updates about how much debt is available to them, about the status of their loans. They're just generally more informed borrowers. And they get really finicky if several months after they get into some asset-based lending arrangement with you, they're being asked to do some kind of piece of housekeeping on a lien when they're not the least bit engaged about that particular transaction, okay? Now, I think that like all other things in the borrowing experience, and as Suzanne has been talking about, these need to be moved forward to the front end of the lending experience. In other words, more digitalization needs to be brought to bear. And bringing digitalization to bear is kind of an interesting topic for lenders, okay? I continuously hear that lenders are a little reticent about it. They're afraid it's going to put them out of a job. I actually think that the opposite is true, okay? The more that banks in general can embrace digitalization and the more that lenders themselves can embrace digitalization, the more value those lenders can deliver to their borrower, the more time that they can spend doing things like providing a training to help the controllers department not fall prey to a phishing scam, or maybe help them hedge a risk. Maybe they've got an interest rate risk, or maybe maybe they're in agriculture and they have some kind of risk to a natural resource. Which brings me to kind of an interesting anecdote, okay? And it's a little bit folksy. It's also a little bit tragic, but it portrays just how high up in the hierarchy of needs a lender can travel, okay? I was recently at an industry event attended by a lot of agricultural lenders, And at this event, one of the lenders, she turned to me and she said, David, I know you look at lots of deployments and interview lots of lenders. Have you ever heard of a lender providing an EAP, an employee assistance program to their borrowers? And I thought, wow, that's an interesting question. And before I answered, I asked her why she was asking me. And she said, well, as you know, we're an agricultural lender, and we happen to be very heavily in the dairy business. And dairy businesses are now characterized by a couple of things. First of all, many of them are family-owned businesses that have been in the family for generations. Many of them are falling upon hard times for the first time in many generations. And unfortunately, many members of those families and businesses are committing suicide because things are so dire with regard to the business. And what was going on was that some of these borrowers were going to that lender asking for help in terms of an EAP, an employee assistance program, to help handle this terribly tragic program at their problem at their borrowers. Okay, so I would put to you, okay, that if digitalization can free you up from the mundane clutter work of your day and help them address some of these far more important and as potentially as important as preventing suicides, then really digitalization ought to not only be embraced, but to be seen as an opportunity to really upgrade the role of the loan officer from merely being sort of, a process facilitator, helping get that deal through loan committee or up the hierarchy, and to actually being a trusted advisor, capital T, capital A, with regard to things far more important. And with that, I want to hand it back to you, Suzanne.
So, playing off of what David was talking about with the millennials and with the digital experience really freeing up organizations to do more with their customer relationships, I wanted to just show you how we're looking at the future of lending. And I think this theme is an important one for all of us. And that is, you've got that customer experience that David is talking about, how the fact that there is a focus on making sure that customers have that digital, quick, streamlined, transparent experience. And what that has meant on the lending side is we've seen the emergence of new organizations, of fintechs, for example, really challenging how banking works and moving toward more transparency and open banking where the end customer can see more options and alternatives and have a better experience there. And we're also seeing that banks and lenders that were considered traditional are investing and transforming and becoming much more of technology providers with bringing in programming and other capabilities so that they can offer a terrific experience for the end customer. And really, the revolution is happening throughout the different types of organizations. And in the background, what that means in order to fuel that from end to end and to make sure that there is a true digital experience that's efficient and high quality, these platforms are starting to arise. And we're seeing more lenders are moving away from legacy to using third-party platforms and stopping thinking about one big system or multiple systems and just thinking more in terms of a platform where they can plug in all the capabilities they need to better manage all their vendors and all their activities. So, in summing up, what I would say is this. The back-end process is what you can control. You can't control the market. You can't control the debtor's activity, other lenders, but you can control how you meet those challenges in a way that's automated, accurate, and efficient, and with the transparency needed. And that's really the main point, I think, of today's webinar.
Wow. Thank you, Suzanne and David. That is some very timely information for modern commercial lenders, and it really shows how the commercial lending space is both full of uncertainty, both uncertainty and hope. There's a ton of opportunity out there to kind of break through the clutter and be successful in this very, very volatile marketplace. At this time, I want to take some questions for Suzanne and David. As a reminder to those in attendance, questions can be asked using the chat feature located at the bottom left of your screen, or the questions tab. So feel free to get your questions in right now for David or Suzanne. We'll take a few here in the next few minutes. But we do have a couple to start with here that have come in. And I think, David, we can start with you. Where is most of the time wasted in the processing of a loan?
So I'm quite certain that the most time gets wasted on simply carting information from one thing to another. Almost screens stare and compare. Okay, folks have a commercial loan origination system open on one screen, and on the other screen they've maybe got a window into the core system or the Lien system, and they are identifying information of some type, okay, from one screen and putting it into another. And the reason I said identifying information is because it happens across multiple categories, okay? It happens across borrowing business name. It happens across guarantor. It happens across addresses. It happens across, important things like the entity for which we have financial statements. And if I'm being verbose here, it's actually on purpose because there are too many parameters across which folks are staring and comparing and re-entering data. And they're important things, okay? They are processes or little cartings of data that invoke instances like the one Suzanne mentioned a little while ago, where someone is in a hurry to get to loan committee, and they put into the Lien system, okay, an incorrect name of the entity by some tiny characteristic like a space or something like that. And it might not be completely accidental. It could be the result of a process started by a borrower that's committing credit fraud. So that's where most of the time kind of gets wasted, and where many of the sort of more risk-inducing errors occur.
Great, thank you, David. A second question that has come in, Suzanne, I'll give this one to you. What kind of metrics would someone use to understand the health of their liens?
Well, there's multiple metrics. I mean, I think one thing that we provide is KPIs, we call them, to assess your portfolio and where it is as far as accuracy and any kind of changes to it. So a customer can see, for example, that their debtor information is accurate and is filed appropriately, and if there's any percentage of error, and they can drill into any kind of problem that they might have to resolve. Other metrics are around rejections, of course. If there's anything there, that can also be surfaced. And we can also look at efficiency around operations and the number of liens and when they're filed, and searches as well. So there's multiple different metrics, and usually we will work with a customer to look at them and kind of baseline that, and then really when you think about metrics, you have to start with where you are and then look at how you progress over time.
Wonderful. Thank you for that, Suzanne. Another question I think, Suzanne, you would be equipped to answer is as follows. Does Lien Solutions have the capability to communicate with their lenders via robotics, machine learning, AI that have been created by those lenders that are intended to sustain automation between a vendor and a lender?
Yes, and I can also take that, separately. We can talk in more detail with that particular person who's asking, because they might have particular scenarios in mind. But I will say this: we have a few of our larger customers who do have situations where we have automated logic, and there is robotics behind it on their side, and we are going back and forth providing the right information and transactions based on their needs.
Great, thank you. David, in your experience working with different financial institutions, what percentage of lenders do you see with a single platform to control their entire lending process. So in essence, how often do you see automation across the board in the banks that you work with?
So automation across the board rarely ever happens, and even plenty of banks that have commercial loan origination are still struggling with integrations that has folks doing a lot of rekeying of data. Now across the entire loan life cycle, you might touch it at the very beginning, onboarding it with CRM, then it would travel into the commercial loan origination system, perhaps integrate with the core, and then afterwards kind of hand the loan off to a loan servicing system, okay? And that's before you even get into maybe some analytics, okay, on the portfolio, or maybe a project management capability, which I wouldn't want to see a bank doing. Some, project management or deal flow capability for whoever's managing the assignment of deals to loan officers and underwriters and credit committee folks. So still, I think far too many systems. This happens, certainly because one system kind of can't do everything. Certainly we will always have sort of commercial loan origination with loan servicing as a complementary thing. But there's still too many systems going on, a few too many handoffs between systems, and whenever you have a handoff, you either have to automate it, and people struggle with that, or you have to do it manually, which can invoke errors, as we talked about a couple of minutes ago.
Thank you, David. I think that will be all the time we have for today's webinar and any questions and answers. If you have additional questions, and this is to everyone in the audience right now, any additional questions, comments can be directed at Suzanne or David through their email addresses that you see on your screen right now, Suzanne.Konstance@WoltersKluwer.com or d.O'Connell@aitegroup.com. Thank you so much to David and Susan for their David and Suzanne for their time and expertise today. It's been a wonderful, wonderful presentation. As we noted earlier, we'll share a link to the recording of this webinar when it's available. Please feel free to share that link with your colleagues that may benefit from the content we learned about today. With that, it concludes today's webinar. On behalf of Wolters Kluwer and Aite Group, thank you for your attendance and have a great day.